I'm gonna give you guys 3 different dividend kings that have really come down in share price. And that seems like particularly good pickups for your portfolio as we go into November. But in case you're new to the channel, then my name is Casper, and here we strictly talk about investing and financial freedom. So if you really like investing, and if you're on a mission to retire early, well then press that subscribe button below. And don't forget to leave a comment below on which stocks you have your eyes on going into November. So the first dividend king on my list is Lowe's, ticker symbol LOW. They are currently down by 12% during the last month, and year to date they are down by almost 8%. So they've definitely suffered a pretty big loss in share price, especially during the last month. When looking at the current valuation, they have a PE ratio of 13.71, and that is almost 22% below their 5-year average. So there is a bit of a discount to be found here. And right now, then the mortgage rate is at its 23-year high. And a lot of homeowners, they have a lot of equity built up in their homes. And they also currently locked in at the much lower percent ranges. And in fact, then 80% of the outstanding mortgages, they have an interest rate that is below 5%. So most homeowners, they don't really want to sell their houses. They want to keep their house and they want to keep their low interest rate. And that does of course have a negative impact on the housing market. And as for Lowe's, then has this definitely had a negative impact on their share price. What is happening right now in the housing market does decrease the demand for Lowe's products. And at the same time, then is the US consumers not spending as much as they previously did. And that does of course also have a negative impact. But let's have a look at the dividends. They currently have a dividend yield of 2.4% and a payout ratio of almost 31%. And that is amazing because it means that they can very easily sustain the current dividend, and they also have a lot of room to increase the dividend in the future. They also have a 5-year growth rate of 19%, and that is incredible and very hard to beat. And they have also been growing this dividend for the last 60 years in a row, and that does of course officially make them a dividend king. So Lowe's is looking like a pretty good buy right now. The price is very low and the dividends are very hard to beat. So moving on to the second discounted dividend king on my list, and here we have Target, ticker symbol TGT. And during the last month, the share price hasn't really moved. However, year to date, they are down by almost 30%. So a very substantial drop in share price for Target. And they are right now sitting at their 52-week low. I mentioned in the last video from October that Target could potentially drop to $100 or even below. And if it did that, then it would be almost impossible not to buy the stock. But let's have a look at their dividends. They currently have a dividend yield of 4.1%. And that is the highest it has been since 2019. Not only does Target have a very nice dividend yield of 4.1%, but they also have a very nice 5-year growth rate of almost 12% and a very nice dividend growth history, where they have been increasing their dividends for the last 54 consecutive years. Overall, then is this a great stock to consider for your dividend portfolio, and I might have to revisit the stock myself, especially if the price drops below $100. However, moving on to the third discounted dividend king on my list, and here we have a company that we all know, and that is PepsiCo, ticker symbol PEP. They are down by 4% during the last month, and year to date they are down by 11%. And they are currently sitting pretty close to their 52-week low as well. They currently have a PE of 21, and you might not consider that to be very low. However, it is 13% below their 5-year average. And it is not very likely that PepsiCo will become much cheaper than what it already is. It is a really strong company that has always performed very well. And over the last 5 years, they have given a total return of 63%. It is a really big company that grants the investor both safety and reliability. And that is exactly what we as dividend investors want. But let's have a look at their dividends. They currently have a dividend yield of 3.17% and a payout ratio of 64%. I would usually say that having a payout ratio at 64% is a bit high. However, for such a mature company and a company with such a high cash flow, then I wouldn't really consider it to be a problem at all. They also have a very nice 5-year growth rate of almost 7%, and they have been increasing that dividend for the last 50 years in a row. Overall, then is this a really high quality company that is finally starting to look really attractive to us dividend investors. That was basically all I had in today's video. Let me know in the comment section below if you have any plans on buying any dividend stocks in November. I hope that you liked today's video, and if you did, then don't forget to smash the like button below and subscribe to my channel for more weekly content just like this. See you guys in the next one.